Hi, I'm Jared Brown, Australian expat financial planner based here in Singapore. Thank you for tuning into my video today. What I'd like to discuss today is how to avoid becoming a mortgage prisoner. Now, you may have heard this term in the media. It's starting to arise quite frequently now. What this means is people who are coming off fixed loans, values in property prices are dropping, equity is disappearing, and repayments are going to start to increase. So what is happening in the market? What can you do to avoid this? Let's dive right in. Now, first and foremost, you've probably seen some of the headlines when it comes to Australian property prices. Many of the banks are looking at 20 to 30% declines, particularly in many of the capital cities in Australia. I think the reality is it will be softer than that, but given that interest rates are rising, given that inflation is rising and people are going to start to become a little bit more cautious about their spending, chances are property prices will soften at least to some extent, particularly in, some of the less blue chip areas right across the country. Now, what does this mean? Well, it means a couple of things. First, it means that as values of your properties decline, then it also means that the equity, that is the difference between the value of the property and the amount of your mortgage, i.e. the amount owed to the lender, will start to dissipate as well. So what is also happening at the same time, inflation is on the rise all over the world, particularly in Australia. We're seeing energy prices go through the roof. Prices of groceries you've no doubt seen in the media are also on the rise. So this means that interest rates also have to be lifted. And we've already started to see the Reserve Bank of Australia increase rates. We've seen fixed rates and variable rates both rocket, particularly the fixed rates over the last few months. And we're now seeing most fixed rates between 1 and 5 years sit anywhere between about the high 4s and the low 7s. Now that's a far cry from the 2s and 3s that we saw last year and even the high 1s that we saw for owner-occupier rates. So what can you do to avoid this catastrophe? What should you be thinking about before prices drop too much? And how can you ease some of the burden if you are concerned about increased repayments into the future? Let's have a look at some of those options now. So you've got a couple of options when it comes to planning for your interest rates to increase. And it is best to start reviewing these options with your mortgage broker now before we start to see too much of a decline in property prices in Australia. So first and foremost, you can consider refinancing to another bank with a better interest rate. Most of the banks, particularly the majors, are certainly looking to increase their market share. You may find that you can save anywhere from 0.5 to 1.5% from your rate simply by switching to another lender. This is open to both Australian residents and expats, so don't feel that simply because you live offshore, you don't have the ability to refinance. So that's certainly a good option to start with. The second option I would suggest you consider is even reach out to your broker, reach out to your lender and simply ask for a discount. Many lenders don't want to be losing borrowers. The easiest client to obtain or to get is the client you've already got. So you may find that they offer you even a slight discount to actually retain your business and keep your mortgage with them. So a good option, worth the phone call. Yes, you may be left on hold for a while, but that 30 or 45 minutes that you've got to spend on hold may save you quite a lot of money in the long run. So that's the second one. The third option you can consider is to consider extending the term of your loan. You may have refinanced or set up your loan 5-6 years ago, and you may now be at a point where you've got 24 years left of your repayments. Now, what you can consider doing is to refinance and extend that term back to the 30 years. That will reduce your repayments. Now, it will obviously mean you will pay more interest in the long run. So you may want to consider your overall plan about how you're going to reduce that mortgage going forward, but it may be a great little solution to ease the burden of the increased repayments in the short term. My fourth tip for you is to consider adjusting the frequency of your repayments. You'll find that going to weekly repayments rather than monthly may mean that you save a bit more interest in the long run and again reduce that cash flow burden for you as well. My fifth and final tip when it comes to avoiding becoming a mortgage prisoner is to consider the use of your offset account. As interest rates rise, all of a sudden every dollar you've got sitting in your offset account is now working that much harder for you. Where the interest rate on your mortgage might have been 1.5, 2% last year, if that's now 4 to 5%, that dollar that you've got sitting in your offset account is now doubly or even greater in terms of its effectiveness. So if you don't already have an offset account attached, or if you're not with a lender who allows offset accounts, again, reach out to your mortgage broker, consider your options here, and make sure that you've got a plan before it's too late. Interest rates are going to continue to climb. Very unlikely we're going to see double-digit interest rates anytime in the near future, but they will certainly be a lot higher than they were over the last few years. So consider your options. If you have any questions at all on this, please do drop me a note in the comments. Reach out. Please remember to subscribe and like. Thank you very much for tuning in, and I'll see you next time.